tonight, the federal budget drops. And buried somewhere in the fine print, between the cost of living handouts and the infrastructure promises nobody believes, there's a change coming that could cost the average Australian property investor an extra 40 grand in tax on a single sale. Now, if you own an investment property, or you're thinking about buying one, you need to understand what's about to happen. Because by the time the news cycle catches up, the window to do anything about it might already be closed. Let's break it down. Right. Capital gains tax. Most people have heard of it, but when you actually ask them how it works, they go a bit quiet. So here's the deal. Capital gains tax isn't a separate tax. It's not like income tax where there's a specific rate. What happens is, when you sell an investment property for more than you paid for it, the profit gets added to your taxable income for that year, and you pay tax on it at whatever your marginal rate is. But here's the thing that makes it manageable right now. If you've held the property for more than 12 months, you get a 50% discount. So only half the profit gets taxed. Let me give you a quick example, so this actually makes sense. Say you bought a place in 2016 for 700 grand. You spent 30 grand on stamp duty and legal fees, another 50 on renovations. Your total cost base is 780. Now you sell it for 1.2 million. Your gross capital gain is $420,000. Under current law, you apply the 50% discount. So your taxable gain is 210 grand. That gets added to your income, and you pay tax at your marginal rate. If you're earning around 130 grand a year from your job, that puts you in the 37% bracket. Your CGT bill comes out to about $77,700. That's a lot of money, but it's manageable. You've still made a solid profit on the property. Now here's where it gets interesting. The proposal on the table right now and this has been floating around Canberra for a while, is to cut the CGT discount from 50% down to 25%. That means instead of paying tax on half your capital gain, you'd pay tax on 75% of it. Same example, same property, same numbers. But under the proposed rules, your taxable gain jumps from 210 to 315,000. And your tax bill goes from 77 grand to $116,550. That's an extra $39,000 gone on the same property, the same sale, the same profit. Just a different rule. Now this isn't new. Labor took a version of this policy to the 2019 election. They lost that one, partly because of it. But the political landscape has shifted. Housing affordability is the number one issue for anyone under 40. Treasury analysis leaked earlier this year showed that the top income earners capture over 83% of CGT discount benefits. And the Grattan Institute reckons ending the discount entirely could raise $6.5 billion a year. So the pressure is real. Whether it lands tonight or gets kicked to a later date, this is coming. The question is when, not if. Now the big question everyone's asking, does this affect properties I already own, or just new ones? Based on Labor's 2019 version of this policy, the expectation is that existing properties would be grandfathered, meaning if you already own an investment property, you'd keep the 50% discount when you eventually sell. Only properties purchased after the new start date would cop the reduced 25% discount. And look, that sounds reassuring. But here's the catch. Nothing has been legislated yet. Until the bill actually passes Parliament with explicit grandfathering provisions written into it, you cannot assume you're protected. If you're sitting on an investment property right now and you've been thinking about selling, the window to sell under the current rules might be narrower than you think. Tonight's budget is the date to watch. If they announce it, the clock starts ticking. And even if they do grandfather existing holdings, if you're planning to buy another investment property after the start date, You'll be playing under the new rules from day one. Alright, so what do you actually do with this information? Here's 4 things worth thinking about. Number 1, timing matters. If you're already considering selling an investment property, the current 50% discount is still in play. Selling before any legislative change takes effect locks in the old rules. That might mean moving faster than you planned. It might not, but at least understand that the option exists. Number 2, know your cost base. A lot of investors underestimate their cost base, which means they overestimate their capital gain. Your cost base isn't just what you paid for the property. It includes stamp duty, legal fees, building and pest inspections, capital improvements you've made over the years, and, this is the one people miss, your selling costs. Agent commissions, marketing fees, conveyancing, all of that comes off your capital gain before the discount is applied. On a $1.2 million sale, a traditional agent commission at 2.5% is 30 grand. That's 30 grand straight off your taxable gain. Number 3, offset with capital losses. If you've got other investments that have gone backwards, shares, crypto, whatever, you can use those losses to offset your capital gain. It's called tax loss harvesting, and it's completely legitimate. Talk to your accountant about it before you sell. Number 4, get proper advice. Look, I'm not a financial advisor. This is general information. But CGT planning is genuinely complex and highly individual. A good tax agent can save you tens of thousands of dollars on a property sale. If you're sitting on a significant capital gain, the cost of professional advice is nothing compared to what you could save. Here's the thing that doesn't get talked about enough. This isn't just a tax change, it's a signal. For 30 years, the Australian property market has been built on 2 pillars: negative gearing and the CGT discount. Those 2 policies together have made property investment the default wealth building strategy for middle-class Australians. If the CGT discount gets halved, it fundamentally changes the maths on property investment. The returns shrink, the risk-reward calculation shifts, and a lot of people who were planning to buy their second or third investment property might start looking at other options. Whether you think that's good policy or bad policy is beside the point. What matters is understanding how it affects your money and making decisions based on the rules as they are, not as you wish they were. That's the situation. The budget drops tonight. If CGT changes are in there, you'll hear about it everywhere tomorrow. But now you actually understand what it means, how the numbers work, and what your options are. If this was useful, subscribe. I do this every week. Break down the stuff that actually affects your money, without the spin. No financial advice, just the intel. I'll see you on the next one.